The main difference between the US and the European economies is to be found in growth, and especially in productivity growth. Productivity has been growing by about 2% a year in the last 20 years in the US, and by around 0.5% a year in the euro area. And this big difference in productivity growth between the two regions can be explained by two factors. One factor is the level of R&D spending. R&D spending is in the region of 2% of GDP in Europe. It exceeds 3.5% of GDP in the US. As the second explanation of this difference between productivity growth between the US and Europe is IT investments. Corporate IT investments, exceed 6% of GDP in the US, whereas it's only 3% of GDP in Europe. And so you can rationalize the big difference between growth in the US and in Europe, mostly by looking at innovation, basically. The growth performance of the Eurozone countries is very different. Germany is in a recession or in a situation of very, very slow growth. France and Italy are in a situation of slow growth, around 1% every year. And Spain is in a situation of a quite rapid growth, mostly due to low-tech industries like tourism, like consumer goods, like cars, but still, and this evolution of this divergence between the economic evolutions of the European economies will likely have effects on the performance of the bond market in Europe. Moreover, we know that France and Italy have very big difficulties bringing back their public sector deficits, and we have seen recently a very big widening of the spread of French government bonds vis-à-vis the German government bonds. Overall, we cannot exclude a situation where the European bond market would dislocate because of this divergence in the economic performances, because of the divergence of also of the situation of the public sectors and of public sector deficits. And I don't think that the ECB, which has an instrument which is called the transmission protection instrument to correct possible divergence of interest rates between the European countries, will use this instrument, especially in the case of countries where the deficit exceeds very much the European regulations or European rule for public sector deficits. We have all been surprised by the poor performance of the German economy in the last 2 years. And this performance doesn't improve. If you look at the PMI indices, you see that both manufacturing and services are in a very bad shape. And we have to explain why the German economy is struggling so much. The two main explanations are the degree of openness of the German economy. The German economy has a weight of exports in GDP of 50%, which is huge. And the German economy suffers from a problem of global competitiveness, both in terms of prices, of cost, and in terms of quality of the products. You know that the car industry in Germany suffers from the competition of German car makers, that the chemicals industry suffers from the competition of the US, since energy prices in Europe have risen well above the level of energy prices in the US. And so there is a clear, very big issue with German manufacturing, which is one main cause of the poorness of the performance of the German economy. As the second cause is that the Germans stick to their fiscal targets of having a balanced budget, and they want the budget the public sector deficit to be back to close to 0%, at a time where very large public investments to support the ailing industries and to finance energy transition would be necessary. This policy very much can be very, very much criticized because it's adding to the weakness of the German economy, and it's making, the meeting of the industrial and climate objectives of the German government very, very difficult. France has been conducting a number of supply-side policies, economic policies, since Emmanuel Macron was elected in 2017, including cuts in corporate profit taxes, including a flat tax on capital income, including a reduction of profit taxes. When you look at the consequences and the economic effects of these supply-side policies, you are quite disappointed, because the only positive evolution you can observe since 2017 is a recovery in corporate investments. But you see no recovery in productivity. You see no growth in the employment rates that could be above the European average. And so only corporate investment seems to have benefited of these supply-side policies, which is quite depressing. An explanation could be that even though supply-side policies have been, and especially tax policies, favorable to the corporate sector, have been implemented, put in place in France, the situation of supply in France remain very much handicapped vis-à-vis other European countries. And saying so, I think of regulations. You know that France is a very highly regulated country. You have in mind also the level of production taxes, which are very clear handicap for corporates. Production taxes amount to 4% of GDP in France. They amount to less than 1% of GDP in Germany. So the explanation of this very limited effect of the supply-side policies in France can be that they have brought France closer to the European average, but have not created a competitive advantage for France compared to the other European countries.